Hey everyone, and welcome. With 2026 right around the corner, I'll bet you're starting to think about your financial goals. But let's be real, if you're just starting out with a small amount of money, where do you even begin? Well, today we're going to map out a smart way to get started. All right, let's just get right to it. This is the question on everyone's mind, right? You've got 1,000 rupees, maybe a little more, maybe a little less. Can that small seed actually grow into something big? The answer might just surprise you. But first, we have to talk about why doing nothing is actually the riskiest thing you can do. I mean, just think about it. What could 1,000 rupees get you a few years ago compared to today? That's inflation in action. Every single day, your money is just sitting there in a bank account. Its actual buying power is slowly, silently getting eaten away. So the most important thing to realize is that we have to make our money work for us, just to keep up. So when we think investing, where does our mind usually go first? Yep, the stock market. Buying shares in companies we know. It seems pretty straightforward, but you'll see the reality is a bit of a maze. Just look at this number. Over 8,200 companies are listed on India's stock exchanges. Faced with a mountain of options like that, how on earth are you supposed to pick the one that's going to be a big winner? It's a huge task, and as we're about to see, the stakes are incredibly high. And wow, this slide really shows you the two sides of that coin. If you had put 10,000 rupees into Adani Power 5 years ago, today that would be worth almost 2 lakh rupees. But if you'd put that same 10,000 rupees into Z Entertainment, it would have been chopped in half to less than 5,000. It is the ultimate high-risk, high-reward game. See, picking the right stock isn't about getting lucky. It's practically a full-time job. You need to understand all this complex stuff. Fundamental analysis, technical charts, financial ratios. It takes hours and hours of research. And on top of that, some of the really famous stable stocks like MRF, a single share costs over 1.5 lakh rupees. That's just out of reach for most of us starting out. So, if trying to be a stock-picking genius is a minefield, what's the alternative? Let's talk about how we can tame this wild market with a much simpler and, frankly, much smarter approach. You know, investing has gone through this really cool evolution. We started with that high-risk game of picking single stocks. Then came mutual funds, which were great because they brought in diversification. But now we have an even more streamlined, optimized tool, especially for beginners, the Exchange-Traded Fund, or ETF. Let's quickly break down the key differences here. ETFs trade in real time. That means you can buy or sell them anytime the market is open, just like you would a stock. They also have lower fees. That's the expense ratio, a tiny percentage you pay each year. And they usually don't have exit loads, which are these annoying penalties some mutual funds hit you with if you sell too soon. All of this makes them way more transparent and cheaper for beginners. And the results? What does this actually look like? Well, by just investing in an ETF that tracks India's top 50 companies, the Nifty 50, you could have seen an average return of over 16% every year for the last 5 years. That's the power of not trying to beat the market, but just owning a small piece of all of it. Okay, but a truly smart portfolio doesn't just stop with stocks. There are other really powerful types of investments that can play a huge role in your journey. So let's expand our horizons a bit. First up, the one you've all heard about, cryptocurrency. At its heart, it's a digital form of money that was born after the 2008 financial crisis. It was designed to work completely on its own, without any government or bank controlling it. And that independence is really the key to its appeal and, well, its controversy. And the returns, well, they have been absolutely mind-boggling. Over the past 5 years, Bitcoin has delivered a staggering return of over 700%. I mean, that is the kind of explosive growth that can completely transform a small investment. And it wasn't just a one-off thing. Ethereum, another huge name in crypto, has done even better with an 800% return in that same time frame. The potential for massive gains is undeniable, but it comes with a major, major catch. And that catch is volatility. Extreme volatility. These things can swing wildly in price. I'm talking 10, 20% in a single day. This is the absolute definition of high risk, and it is definitely not for the faint of heart. Now for something completely different, real estate. You're probably thinking you need lakhs or crores to get into property, right? Well, that's not true anymore. These things called real estate investment trusts, or REITs, let you buy a tiny slice of huge properties. like shopping malls or giant office buildings, as easily as buying a stock, sometimes for just a few hundred rupees. And this is what makes REITs so interesting. It's not about those explosive crypto-style gains. It's about steady, passive income. You get a solid annual dividend yield, which is basically like earning rent, plus some modest growth in the property's value. It's really an income-first kind of investment. And finally, we can't forget the classics, gold and silver. These have been seen as a safe store of value for centuries, and you can see they've still delivered really solid returns. The easiest way to own them is, again, through ETFs. Just remember, these don't pay you any income. Their job in your portfolio is to provide stability and growth. Okay, we have covered a lot of ground. We've looked at stocks, ETFs, crypto, REITs, gold, the whole shebang. So now it's time to put it all together in one simple comparison to help you make sense of everything. Think of this as your master cheat sheet. You can see right away that stocks and crypto offer that very high return potential, but they also come with the highest risk. On the flip side, ETFs, REITs, and gold are much safer plays for a beginner. If passive income is your main goal, REITs are the clear winner with that high yield. And notice that tax column? Crypto gets hit with a pretty high flat tax rate right now. You can use this table to really match an investment to what you want to achieve. So you have the information now. The map is basically laid out right in front of you. But knowledge is only powerful if you actually act on it. So let's talk about how to go from learning to doing. If you only remember 3 things from all this, let it be these. Number 1, start with diversification. An ETF is a fantastic, low-cost way to own a piece of the whole market instead of gambling on one company. Number 2, match your investments to your goals. Don't chase crazy crypto returns if what you really need is steady income from a REIT. And number 3, and this is maybe the most important, be consistent. Investing small amounts regularly is so much more powerful than trying to perfectly time the market. We've covered the why, the what, and then the how. The path to building wealth, even if you're starting small, is clearer than it's ever been. The map is officially in your hands. So the only question left to ask is, what's your first step going to be?